This brings us to our next topic, my favorite topic, which is investments. So I'll give you all just a second to read this quote from Warren Buffett. He's the most pronounced 20th century investor. Hopefully some of you have heard of him, but he has had tremendous success in what's called value investing over his lifetime. So I'll give you all a second. So I really love this quote, and it really underscores what I briefly just talked about, which is don't worry about the ups and downs of the market. It's so easy to get hung up on what we're hearing on the news. It often causes panic. But what you'll see is that over time, the markets do go up. And another thing you'll notice is that the markets do not always directly correlate to what's going on in the economy. The markets are forward-looking, so as long as they're optimistic about where it's headed, even things like wars or recessions don't necessarily mean that the market is going to tank. All right, so all of you are dentists, and when a patient comes in, what's the first thing you do? You examine them, I'm sure, and you get a basic overview of what's going on in their mouth and things of that nature. As financial advisors, financial planners, we do a similar thing, but we do that with your finances. So we're sort of like the doctors of your financial life. So what do we do first? We analyze two specific things. One is your ability to take risk. One is your willingness to take risk. Your ability to take risk is based on various factors. So think your current age, how much you have saved right now. A lot of what's actually in that retirement planning questions is your ability to take risk. How much do you spend? How much do you need for retirement? That's all your ability to take risk, because the closer you are to retirement age, the less we kind of want to take risks with your money, right? We don't want to risk your money selling off when you're relying on that income stream. But the younger you are, you probably could take on a little bit more risk because you don't need to see that money for many years to come. Your willingness to take risk is something that we're going to go over in a lot of detail, and it's equally, if not more important, than your ability to take risk. The reason your willingness to take risk is so important is for the following reason. So often we have clients, or new clients I should say, coming in, and they say, I don't know what's going on. I tried investing on my own, and I see the market has averaged 15% return, let's say, over the last decade, right? And yet somehow I've lost money. How did this happen? We get this question all the time, you know. By the way, by a show of hands, how many of you do your own investing? Okay. How many of you work with a financial advisor to invest? Okay. And how many of you kind of do a mix of both? You're not really too sure, and okay. All right, so good. I just like to get a sense of everyone's financial agility, so that's helpful to know. So we see this often with clients who do their own investing, but it also happens even when you use financial advisors. You see the market has, again, going back, averaged 15% over, let's say, the last decade, and yet you've lost money. And why does this happen? Well, as we all know, the market is not a straight line up. It's a roller coaster. That has been extremely clear this year, right? We had the market sell off and it's rebound dramatically. But what often happens, and again, we saw this happen this year too, people start panicking and they sell when the market is dropping, okay? So for example, earlier this year, there were concerns around tariffs. It was dramatic. We've never seen tariffs of this height before to this extent. The market was certainly panicking. There was so much uncertainty. The number one thing markets don't like is uncertainty. Why? Because they can't plan ahead for this. Companies can't plan, they can't hire, they don't know what the future looks like. So it really pauses economic activity. What else didn't we know? We didn't know what this new bill was gonna look like. So the market sold off, right? So often we see clients are panicking or investors panic because they say the world's coming to an end. This is unprecedented. You'll hear that word all the time, unprecedented. And you sell off when the market dips. Now all of a sudden the market's going back up. And investors are saying, why am I not in on this? I'm missing out, right? We call it FOMO, the fear of missing out. That applies in the investment world for sure. So what often happens is you sell low and you buy high. And that's clearly no way to make money. And this is why your willingness to take risk is so crucial when analyzing how you should be invested. If it was as easy as everyone could just be in the stock market, well, that would be very simple, and I would probably not be in a job. But it's not that simple, because we do have to take into account what your willingness is to take on risk and to really stomach those downturns. All right, so why does the market fluctuate so much? There's various risks that go on. I just talked about a few specifically that happened this year. There's a huge topic that's been going on, especially since COVID, is inflation risk. Right now, we're looking at some interest rate risk as the Fed is beginning to cut rates. We have political risk. We added that one because I thought it was really important given our new administration and all the changes that are going on with tariffs. And then I'm not going to touch on each of these, but company or industry specific risk, I want to highlight that one because that is one that can actually be what we call diversified away. If you have all your eggs in one basket, if you have all of your investments in one company, if that company fails, you're going to lose a huge chunk of your investments. And this is why we recommend taking advantage of diversification, because there's no reason to take on that additional risk of one company failing. All right, so how do we measure these different types of risks? What does our team look at? One tool that we use is what's called the recession risk dashboard. It may look a little weird because October has some dashes in it. That is due to the government shutdown. A couple of these data points were not released during the shutdown, and given how long it took to reopen, they won't be releasing them until next month. However, there's other resources and data that we collect to give us an indication of what these different points look like, even for last month when the government was shut down. And it looks pretty in line with September. So we could use September as the gauge here. And as you can see, we're still in expansionary times. And I want to just highlight that because I know that, and this is not a bulletproof metric, these are what we call forward-looking indicators. So these are indicators that happen usually before an economic expansion, an economic downturn, that can signal to us where we may be headed. So for example, housing permits, that would be a leading economic indicator because if housing permits are positive, that tells us more people are trying to buy homes or build homes, and that generally increases economic activity and is good for the economy. So these are the types of tools that we use and we look at to see where the economy is headed. We've seen a lot of, lately we've seen a lot of negative news lines around what employment data is looking like. Going forward, we are still cautiously optimistic about where this economy is headed. Even though we've seen some signs that may be signs of concern, we're optimistic that with interest rates declining, that will help economic activity. And we're also optimistic that with the new tax bill that was recently passed, once taxpayers start really benefiting during the next tax cycle from those tax breaks, that's even going to dramatically impact economic activity even more. So we're pretty optimistic, and these indicators are also pointing to expansionary times.